This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks set to follow Wall Street lower with mounting inflation concerns pushing long-dated Treasury yields to the highest since 2007. Brent crude holding above $110 as President Trump threatens new strikes on Iran within days unless there's a deal. And Vladimir Putin arrives in Beijing for his summit with Xi Jinping with energy projects in focus. Of course, it's really the focus on the fallout from the Iran war, inflation, repricing. And what's interesting, Haidi, is that despite the fact that we are seeing oil prices easing, the global bond rout continues. And what a time to be here at the Morgan Stanley-MUFG Japan Summit. It's a third year running as we have more investors focused on the Japanese markets. And really, JGB is one big driver of the global bond rout. Of course, we have fiscal risks in this country with Prime Minister Takaichi's new extra budget, but also at the same time, inflation risks as the energy shock continues, a country that's heavily exposed to Middle Eastern oil. So perhaps really a reflection, Haidi, of global concerns that we're seeing right now in the debt space.
I think one of the interesting things that you touched upon, Shery, just now is really perhaps we're starting to almost see that decorrelation between what's going on with oil prices and what's going on in bond markets. We have seen these traveling in lockstep, right? But in this session where we've seen these new highs for bond yields in the US, we can't really even blame oil prices, which have been kind of fairly stable throughout the course of this session, given the lack of development when it comes to this ongoing fragility of the ceasefire. But you said it, yields on Treasury's longest dated bond rising to the highest level in just about 2 decades. The fears over accelerating inflation risks forcing central bankers potentially to raise interest rates. And that's really the fear that bond traders are contending with at the moment. That 30-year yield as much as 7 basis points higher to 5.2%. The last time we saw this was really on the cusp of the 2007 global financial crisis when we saw this sort of thing happen. And we are seeing not just the US, of course, but also bond markets, as you say, in Japan, but also in Europe, tracking that as well. But this is also what we're watching when it comes to oil prices at the moment, waiting for Brent to come online in the next hour. But New York traded crude, not much of a move, about 0.1% there. This, as we heard from President Trump, threatening Iran again with, quote, a big hit if there's no deal soon. The resumption of strikes are on the table as part of this broader push to put an end to this ongoing conflict. And so we'll be continuing to watch the impact on equity markets as well. We're seeing Asian stocks set to follow Wall Street lower after these mounting inflation and bond yield concerns. Aussie shares looking like we'll start off on the back foot, having seen those gains in the previous session. But this is a market that's only seen 2 positive sessions out of 8. That surge in longer maturity Treasury yields testing the resolve of global bond investors, torn between the possibility of locking in high rates, the risk of an even greater sell-off. Let's bring in our Bloomberg MLive strategist Mark Cranfield for more. And Mark, it's interesting, I think, as Shery and I were both sort of talking about that oil prices, at least in the previous session, seems to have taken a back seat, and we're seeing this momentum driving yields on their own.
What's happening is the bond vigilantes are having a great time because they are exploiting the disconnect between monetary policy and fiscal policy. They love it when central bankers and governments are not on the same page. And that's exactly what's happening across the world at the moment. Inflation expectations are as high as they've been for several years. And the markets are expecting that central banks will be under pressure from their governments to go very slowly in terms of raising interest rates. They're not going to be acting proactively. They're going to let it run for a while, and then maybe they will raise interest rates after that. That's not good for bond markets. Bond markets like to see you getting ahead of inflation expectations. At the same time, governments are spending even more, particularly because of the defense sector. The war in Iran is forcing not just the United States, but the Europeans as well, and the rest of the world to respond quickly and ramp up defense spending. And to do that means their fiscal deficit is going to get worse. Investors can see that. More bond issuance. And it's been made clear, even Japan made a U-turn this week. Prime Minister Takaichi said that she now has to do an extra budget, which wasn't expected by the market. So investors can see there's more bond supply coming. Yields are already high. Curves are relatively steep. And central banks are probably going to be relatively slow to address the inflation problem. That's a perfect storm. Bond vigilantes love it. When it's in this situation, it is going to take a lot to put it right. Ending the war in Iran would be a good step, but more needs to be done to get inflation down and then bond investors will feel more comfortable.
We're seeing a big driver being JGBs as well because of all of those concerns that you mentioned, right? But still, the Japanese yen, despite surging yields, pretty weak. What was really interesting to me overnight was what Secretary Bessent was saying about the Japanese economy, how it remains solid, how excess FX volatility is undesirable. Almost some of the same talking points that we've been hearing from Japanese authorities all along. But, I mean, will this help considering the fundamental backdrop?
Foreign exchange traders can see there's a credibility problem when it comes to defending the yen. They were very disappointed. When Scott Bessent went to Tokyo recently, they were fully expecting there would be some kind of coordinated approach between the US authorities and the Japanese authorities. Either very, very strong verbal words to make the yen seem stronger, full support for a Bank of Japan interest rate hike, and probably actual intervention all at the same time. None of that happened. That's why dollar yen is back up at the 159 level. Also, the Japanese authorities will probably now regret the fact that they did not act more toughly when dollar yen was falling. It got to 155 and they stood back. They should have pushed dollar yen below that level. Traders can now see they've got a little floor down there where they can come in and buy the dips on dollar yen. The top side is open because the Bank of Japan is acting so slowly. It now looks as though there's a pretty good chance the BOJ will raise interest rates in June. We have a speaker from the BOJ, Koeda, tomorrow, who's likely to move to the hawkish side, and then Governor Ueda will speak in early June. By the time that's done, the markets will be expecting, but in a way, it will be a wasted rate hike. Because they didn't go in April, they're now so far behind the curve. Yen traders can see that. They have no confidence in the Bank of Japan and the Japanese authorities being ahead of the curve. So it's all catch up. And at the same time, you've got US yields rising, which also gives the dollar more support. It is a scenario that is not working out very well. If the Japanese authorities really want a stronger yen, they have to be much more decisive and surprise markets with their timing of intervention.
It's really interesting that you mentioned that 155 mark because I was really looking at it closely and it failed to break it during that time when we suspected Japanese authorities intervening. Mark Cranfield there, Bloomberg M-Life strategist, as we discuss the pressure on the Japanese yen, of course, coming also from the inflationary risks from the oil shock as well. President Trump threatening to resume strikes on Iran in the coming days if a deal is not reached. The comments, which come after Trump said he was holding off on a new attack at the request of Gulf allies, raised the prospect of a return to active hostilities in the Persian Gulf.
I had made the decision. So they called up, they had heard I made the decision. They said, sir, could you give us a couple of more days because we think they're being reasonable.
How many days for Iran to come to?
Well, I mean, I'm saying 2 or 3 days, maybe Friday, Saturday, Sunday, something, maybe early next week, a limited period of time.
For more, we're joined by senior editor Derek Wallbank. Derek, I mean, he had just said that he called off fresh strikes. Now he's threatening them again. Where are we in the negotiations?
Well, Shery, we're right now in the middle of a short pause, according to the president. He had said that today was supposed to be the day that things were going to happen, that he had been called by some Persian Gulf allies and said, please don't go forward. He decided not to. And now the new timeline that we hear the president talking about is something with a decision point maybe over the weekend, maybe early next week. We'll have to see on this. But we have seen, over the last, let's say, days to weeks, a sort of back and forth between the president, depending on when you catch him, about there is a possibility of escalation, re-escalation, hitting back harder for a period of time, and then also this real desire to not engage further. I think that the White House is very sensitive to a lot of the economic notes that you mentioned before. I would add in retail gasoline prices. I would add in diesel prices. I would add in the supply shocks that you see and pressures that you can see on other things all throughout the supply chain. I mean, we had this great article that came out just the other day from one of my Singapore colleagues talking about how a whole bunch of things downstream, from tires to condoms to the gloves that you wear in hospitals, were all being charged more off of, the downstream of the Iran war. And so certainly, as affordability is the number one issue in the midterm elections, we have a big primary day going on today in the United States and several states. This is all top of mind. At the same point, if Donald Trump wants to get to the point that he's going to get an out, he needs to, in the view of Trump allies, needs to have something that he can sell as a defensible way to get out. He doesn't have that. All of the stuff that we've seen when we've seen these offers come up and bubble up and become public, the things that have come up suggest that both sides are still very far apart, each side insisting on something that the other says is a red line.
We're hearing that NATO is discussing the possibility of becoming involved, Derek, in terms of helping passage for vessels through the Strait of Hormuz, which of course remains blocked. What do we know about this, particularly, I guess, with the context of how we know the president feels about NATO?
Well, Heidi, that's exactly right. There has been a long-standing theory in international relations called the Pottery Barn rule. It's named after a U.S. retail shop, and it basically says you break it, you buy it. The idea that if something you do causes a situation to come out of balance and become a problem, you're now responsible for fixing it. Now, that has been NATO's view. Donald Trump has had the view that the Strait of Hormuz is far more important to European allies. They ought to take a bigger role in it. And at some point, how it got to that point becomes a little bit subsidiary to the idea that it can't stay at that point, that you have, as I was mentioning, these downstream impacts that you have to figure out and that you have to deal with. What happens when we need fertilizer and we can't get the fertilizer out? What happens, about the continued escalation in airfare prices and all of these sorts of things. So it's no surprise that you're starting to see a shift into the, okay, here's where we are, where do we go from here kind of thing. The other thing that I would flag here, though, and I mentioned the political thing, we did just see a procedural vote in the United States Senate today pushing to say that senators in that Republican-held chamber are not necessarily satisfied with the information they're getting and the way that this is going. And we did see a procedural vote go against the president on the Iran war. Much more to do there. It's not going to force him to stop. But you are starting to see some of this discontent bubble up politically, so that's something else to watch for.
Yeah, fireworks ahead of the midterm election. Senior editor Derek Wallbank there. And still to come, Morgan Stanley Japan CEO Alberto Tamura joins us here at the bank summit in Tokyo. And later we speak with their chief Asia and EM equity strategist, Jonathan Garner. Plus, later in the show, a special report on why some SoftBank insiders are growing uneasy over Masayoshi Son's OpenAI bets. Much more ahead. This is Bloomberg.
Take a look at how we're setting up as we have Asian equities looking like we'll track Wall Street lower given these surging yields continue to remain the top theme for risk assets. We're seeing S&P futures when it comes to here in Sydney trading lower by about 0.5%. This after we saw a brief rebound to the tune of over 1% in the previous session. Still, we have seen more losses than gains when it comes to this broader market. Watch for banks and real estate stocks. They were the big gainers in the Tuesday advance, and tech also seeing some outperformance here as well, but it does look like a lower day. We're also seeing some weakness when it comes to the Aussie. Australian bonds, the yield situation there should get some support from the RBA nearing that neutral rate. Crude is in focus, although not much happening there despite the yield surge. European gas futures up by 3% as we continue to see that extended rally worries deepening over the tightness in that market. Not just Europe, of course, global energy supplies broadly under pressure. The focus is here in Australia on boosting stockpiles. Industry leaders have told an energy producers conference that there is an urgent need to increase natural gas production, warning of a possible domestic shortfall later this decade. Let's get live to Adelaide, where our very own Paul Allen is with our next guest. Paul.
Thanks very much, Heidi. Yes, I'm here with Brett Woods, the Beach Energy CEO and Managing Director. Brett, such an interesting time to be in your business, perhaps the wrong kind of interesting. Against this backdrop of geopolitical uncertainty, also domestic upheaval that I'll get to in a moment, how's that impacting your decision making?
Well, it's a really good question. The challenges we see is probably fundamentally about supply chain, making sure that we have enough diesel to support our field-based operations. But critically, Australia is short of liquids fuels, so 100% of our oil production, and we're one of the country's largest oil producers, is now being diverted to domestic-only refineries, which is really important, and we've increased our drilling execution across our oil operations in Central Australia. So we've got 12 development wells going in at the moment, and then we're going to pivot straight into 10 additional wells to connect and bring online to help support fuel security in Australia. And I think it's been important for Australians to recognise the importance of having access to fuels, given we've gone from 6 refineries back down to 2. It's really kind of exposed Australia in terms of its fuel security.
What are the risks with some of these kinds of investments, though? Because if we get a quick solve in the Middle East, which isn't completely out of the question due to the looming midterms, what does that mean for the cost of the investment in this new infrastructure?
Yeah, I think the important part for us is to make sure that we execute stuff that stays free cash flow positive, even at if there's any drastic deviation to oil price. So we're picking through our inventory of opportunities to make sure that if we do see a drastic turn in oil price, which we're not forecasting, that we are defended on the low side. So you're right, we can't throw everything at it, otherwise you'll stress balance sheet. So we try and do it in a very prudent and capitally efficient manner.
Heidi was mentioning there in the introduction that the changes in the domestic scene as well, the 20% gas reservation, potential changes to the petroleum resource rent tax. How are you navigating that regulatory uncertainty? And is Australia still a good place to invest?
Yeah, again, really good questions. I think the challenge for us at the moment is we've had different ministers of this government say drastically different things, and under the situation where you have a prospective reservation policy, I think the whole industry is very supportive. But at the moment, they're suggesting it's kind of retrospective, that 20% of all exports be diverted to domestic market. And as a consequence, we'll see a short-term sugar hit in terms of lower gas prices. And Monday in the east coast of Australia, we had some of our lowest ever domestic gas prices at around, not ever, in the last 5 years, around $7.50. So what we're seeing is that will drive the investment signals away from investing in projects like we're looking to do. So you may get a short-term benefit for manufacturing for a year or two, but without the constant investment from our industry, you'll soon see the prices return to much, much higher levels without that ongoing investment.
Some of your big competitors like Woodside, Santos, they're looking to streamline operations, find efficiencies. Are you doing the same sorts of things?
Yeah, well, I've been in the job now for 2 years, and when I joined, we're probably one of the highest cost operators in Australia. So we've taken our cost base from $17 a barrel down to $10 a barrel. So we've reduced our headcount from over 800 down to 450. So I think with a 35% lowering of our operating costs, we've delivered a material change in our margin that we generate per barrel. So we're still on that journey. I'm still focused on liberating as much cost and value I can out of our operations, because that enables me to execute more projects. And now we're utilising all the tools, including kind of the AI to help our operations, and even the back office stuff with AI is operating much better. So we'll continue to focus on cost and efficiency. In Australia, we're seeing 4% inflation, so we need to beat inflation each year, otherwise our business goes backwards. So we're really focused on cost.
We are in an environment at the moment with very high energy prices. Companies have strong earnings, strong balance sheets. It looks like the stars are aligning for M&A.
Yeah.
Are you concerned the beach could be a target, being one of the smaller players in the domestic scene?
Well, it's a very interesting point. I think now that the government has suggested 20% of export volumes need to be dedicated to Australian operations. Across the east coast of Australia, the critical energy market here, we're a domestic-only producer. So I think some of the export companies will be looking at us thinking, how can we work with beach, or what can we do with beach to make sure we can offset our obligations and continue to deliver their higher margin export? At the moment, JKM is in the high teens, and Australian prices are in sub-10. So there is a huge arbitrage in value, and so I do see that there are some risks of the larger players starting to look at Beach. But on the flip side, we also have a fantastic balance sheet, less than 15% gearing, very strong free cash flow generation. We have a great opportunity to grow our business, and that's one of the objectives that now we have our big project in West Australia online. Our focus is to grow and try and consume and execute more projects to bring more gas to market.
Fantastic. Brett Woods, thank you so much for your time today. That is Brett Woods, the Managing Director and CEO at Beach Energy. Haidi.
Paul Allen there at the Australian Energy Producers Conference and exhibition in Adelaide. We'll have more from those conversations in Adelaide today. We'll be speaking to Woodside CEO Liz Westcott and the Australian Energy Producers CEO Samantha McCulloch. Those interviews coming up at the times on your screen. More ahead on the Asia trade. This is Bloomberg. Counting underway after a closely watched primary in the US state of Kentucky, pitting Republican incumbent Thomas Massie against a challenger endorsed by President Trump. Bloomberg senior US elections editor Bill Ferris joins us now from Washington. So why, I guess, give us a context in terms of why we should be familiar with this race, why the political world and President Trump in particular is so invested in a congressional seat in northern Kentucky.
Well, thanks for having me. The Republican who holds that seat, Thomas Massie, he has been one of the biggest thorns in President Trump's side since he came back to the White House last year. He has voted to release the Epstein files. He's voted against President Trump's tax and budget bill. And he's been very vocal in his opposition to the war in Iran. When Republicans only have, at best, sometimes 3 or 4 seats, 3 or 4 seat majority in Congress, Thomas Massie is often just written off as a Democratic vote on those things, even though he has a more conservative record than just about any Republican in Congress. So President Trump has made this a very personal fight. He wants to see Massie ousted. He wants to he's been taking revenge against a lot of Republicans who have voted against him in the past. And this is probably the highest profile, biggest test of how strong Trump's grip on the Republican Party is at this point in time.
And that's really what's at stake here if we do see a defeat for the incumbent.
Yeah, absolutely. I mean, there are a lot of questions, about sort of the standing of President Trump. A lot of national polls show voters souring on his handling of things like the economy, of the war in Iran. But within the party, people want to know how strong his grip is. And if Thomas Massie's defeated, it will be yet the latest sign that you defy the president at your peril if you're a Republican. Now, that may not still help them in the November elections. Democrats are still favored, but within the party itself, President Trump still appears to have a strong grip.
The amount of money spent on this election is quite extraordinary. 33 million on this race, according to data that we've seen. But we've got Trump's wing in the Republican Party been on quite a roll recently. So are we still seeing optimism from the Democratic side?
Yeah, you're right on the money. 33 million is a really substantial amount for a race the Republicans are sure to win in November. This is a deep red state, and you're right. President Trump's team has been on a roll. They were able to get some of the Democratic moves in redistricting changed, but Democrats are forecasting that they'll still do well in November.
Bill Ferris there, our senior editor for US elections on this key race. More ahead on the Asia trade. This is Bloomberg.
Heidi, we're seeing a little bit of downside when it comes to oil prices, easing a little bit in today's session. But of course, we continue to see the global bond rout and yields across the world surging to multi-year highs. A little bit perhaps of confusion when it comes to what the inflationary risks are from here, given that we don't know necessarily the trajectory of the Iran war. So in the meantime, we have seen the global debt sell-off. We are talking about the U.S. 30-year Treasury yield now topping that 5%, really reaching intraday overnight to the highest level since the eve of the global financial crisis. The German Bund's 30-year yield also at the highest levels since in about 15 years or so. And let's not even talk about Japan. We're talking about a historic crash for JGB's 10-year, 20-year, 30-year yields. Levels since we haven't seen since the 1990s. We have, of course, idiosyncratic issues as well, fiscal risk, a big consideration here, given that we have seen also the extra budget from Prime Minister Takaichi.
Yeah, let's talk about Japan, Shery, because you're right. The situation when it comes to JGBs and how it's sort of on a crash course to collide with resentment for this market that has staged such a recovery on the back of these governance hopes. And that is really what we're watching at the moment. And Shery, as you mentioned, given that we have these 10-year yields on JGBs at around 2.8%, we're on course for 3%. It's around the highest, as you say, in about 30 years for Japan. What that means is that that's going to start trickling into fears over corporate earnings, lending costs to some of these Japan Inc. companies, right? And do we start to see that trickle through? At the moment, we've got the Nikkei 225 trading in Singapore futures pretty soft, about 0.1% to the downside. We'll be watching that market, of course. S&P futures looking like we'll see a bit of a recovery from the downside that we saw in the previous session. Australia, though, looking very much to track that overnight session lower. We had a bounce of about 1.2% in the previous session, but looking like we're softer by 0.5% when trading kicks off in just under half an hour, Shery.
And Heidi, what a time to be here at the Morgan Stanley-MUFG Japan Summit. We have leading business executives, investors from across the country gathering today. And joining us exclusively now is Morgan Stanley Japan CEO Alberto Tamura. Really good to have you with us, and thank you so much for having us at your event.
No, thank you for having me. We're pretty excited about the conference, so thank you for inviting me.
Your third year in a row, given, of course, the enthusiasm that we're seeing in the Japanese markets. But what a time. I mean, I just spoke to Heidi about yields just surging to multi-decade highs. I mean, this is a situation that Japan hasn't seen in decades. How's that mindset switch happening right now?
I think the mindset switch is perhaps the biggest event over the past year. I think it's affecting pretty much every player in the market, and that could be an individual investor or it could be a financial institution, but it's also affecting the corporates. And the fact that, as you mentioned, that we have positive rates for the first time in decades, but the fact that the yield curve is steepening significantly, along with the uncertainty in the currency market, is effectively pushing everyone to rethink what they need to do with their financial portfolios.
What does that mean for corporate activity in Japan? And I cast this question with the caveat that we do have an ongoing war in Iran that's really leading to prices continuing to rise. And of course, Japan's so dependent on Middle Eastern oil.
Well, like any corporate in the world, I think they need to tackle questions around supply management, material cost, and of course, I mean, the extra layer of currency volatility here in Japan will pose a lot of questions to the management teams of corporates. Having said that, I think the foundation of structural reform here in Japan will continue. I think it will continue to drive corporates to make the right strategic decisions. So all in all, I think the macro environment here in Japan remains robust.
And currency volatility, where does the yen go from here?
I have a view that the currency is going to roll in two directions. It's going to be either strengthening and hopefully moving to the 140 handle level. But depending on how events unfold from here, it could be going towards the 170 level.
What are those factors affecting the 140 or 170?
First of all, I think if it heads to the 170 level, we're talking here about obviously inflationary pressures. We're talking here about what's happening around the world and affecting prices here in Japan.
But how do we get there? Is that the Iran war continuing?
That could be part of it, but I think, as you mentioned earlier, I think concerns around the budget, supplementary budgets, how is the country going to manage the fiscal policy, I think that's going to be the core of the...
Are you leaning towards 170 or 140?
I'm hoping for 140.
For 140, what would need to happen for us to get into the strengthening path?
I think we need to have the Bank of Japan take action. I think some investors believe that the Bank of Japan is behind the curve. So hopefully taking action would be step number one. If things stabilize around the world, maybe that could also be the path to a stronger yen.
What happens if the BOJ doesn't hike in June?
Then I think we will see an impact in not only the bond market, but also in the currency market.
Are Japanese authorities going to allow the yen to get to 170?
I'm not sure if they will obviously have full control over it. I mean, I would imagine that they would not want the currency to weaken before significantly from these levels.
Despite all of the concerns around the economy, we are seeing this massive rally around the AI narrative, right? Is that justified?
I believe it is. I think the benefits around this massive technological development are pretty big, and I think they outweigh a lot of the concerns that are out there in the market. I think it particularly will have a benefit to Japan, given the acute labor shortage. I think that would be one area in which AI will contribute to the country.
Because I was just wondering, especially with yields surging now to multi-year highs around the world, you have valuation issues for some of these big names, or even the smaller ones where, you're looking at growth stocks and perhaps these investments not paying off being an issue.
Yes, I mean, that debate will continue, but at the same time, we need to focus on the fact that, capital is being deployed to, finance a lot of these infrastructure projects. And of course, I mean, AI is already having an impact in the way companies are operating, particularly the ones that are engaging with AI and welcoming AI. And I would imagine that profit margins are probably improving on the back of for companies that are adopting AI for the daily operations.
Another big theme here at the Morgan Stanley Summit has been around defense. How much opportunity is there in that sector?
I think the opportunity is pretty big. I think what Japan has going for itself right now, and not only in the context of AI, but as you mentioned, in the context of defense spending, is a combination of technology and also manufacturing. And you are seeing that reflected in some of the companies that are being, bought by investors. And, that might be one of the kind of like surprises for Japan over the past year, a combination of the AI boom, but also the focus on defense spending. I think a lot of investors are realizing that, the manufacturing capacity and capabilities of Japan, coupled with the technology that it has, is something that is very attractive for investments.
Where have the opportunities been for Morgan Stanley?
Like anything else, I mean, a combination of us providing advisory to corporates, providing access to our investors, to all of these companies. But more importantly, I mean, I think the content that we provide to our clients is critical. Some of these technology advancements are happening very fast. They're very comprehensive. They affect multiple industries at the same time. So I believe that, what we offer as a firm, which is one integrated firm approach, one integrated research approach, I think will be extremely valuable to our clients.
Where are the opportunities, especially when it comes to strengthening the cooperation with MUFG?
In multiple areas. I mean, we have been partnering with MUFG for 16 years in the joint venture here in Japan. We have regular conversations in terms of how else can we collaborate. What else can we do together? These are ongoing discussions, and I think over the many years to come, we will continue to make decisions on how to collaborate, and we will obviously be sharing that with the public domain whenever they happen.
Given the expansion that you're really hoping for Morgan Stanley in Japan, how difficult has it been to get talent in this economy?
Yeah, it has been pretty difficult. It's always a challenge. It is a challenge for the country because of the acute labor shortage. But, as a firm, we continue to focus on culture, attracting talent, providing...
Are JGB traders the most rare these days?
They continue to be a target, but I think the peak of the poaching of JGB traders was probably around 2024, heading into 2025. I think we've gone through that peak.
When it comes to surpassing Nomura, what's the timeline?
I don't have a timeline, but we're pretty focused on becoming the top securities house in Japan, and that would be our ultimate goal. So we'll continue to work on that.
When it comes to private credit solutions, for example, you have MUFG Morgan Stanley Credit Solutions. Can you give us an update, especially given the risks that we've seen globally when it comes to private credit?
This is one of the collaborations that we have with MUFG. We have a subsidiary that focuses on private credit, a combination of sourcing deals but also placing deals. And I think we're in a pretty good position to not only help our clients when they need something, but also obviously allocating some of the paper to our investors. So we're pretty well positioned for that.
Alberto Tamura, it's really good to talk to you here on Bloomberg Television. Thank you so much for having us here. He's the Morgan Stanley Japan CEO at the Morgan Stanley MUFG Japan Summit 2026, their third year running. This is Bloomberg.
Well, the annual Sohn Investment Leaders Conference in Hong Kong kicks off today as market players gather to discuss their picks and strategies. Joining us now is Seth Fischer, who's a founder and CIO at Oasis Management. Seth, always great to have you with us and always around the Sohn Conference, of course. The broader macro environment at the moment is so interesting and so dislocated in a lot of ways, right? We've got the ongoing conflict in the Middle East, oil prices. That's also now driven the surge in yields amidst these fears of broader inflation. And that's not to mention the sort of fundamental dislocations that we might continue to see from AI too, right? How is all of this potentially informing, I guess, the prism through which you make some of these strategic decisions?
Makes it for a complicated world. Thanks for having me, Heidi. There's a constant competition for capital. We've got to continually think about the rising bond yields, for that matter, and how companies have to perform a lot better than they used to. Certainly they used to in a deflationary environment. And then we have the world of net energy importer as Japan is. And we need to think about companies that are thinking for that risk and kind of planning for that forward. So we'll continue to engage with companies that I think have incredible opportunities, that are incredibly cheap to their potential. And so that competition of capital means that the upside needs to be even better.
Does the downside get a little bit more interesting too, right? Because we were just talking about the case when it comes to Japan. If you've got the 10-year pushing 3% levels we haven't seen in about 3 decades, when do you start seeing that feed through to the vulnerabilities of companies that are going to be exposed by higher borrowing costs? Is that a theme that kind of matters to you at this point?
Actually becomes a lot less of a theme for borrowing costs, and invariably an enormous amount of companies still have net cash. Enormous amount of companies have a very little amount of leverage. So the leverage, I think, is not primarily the issue. The issue is clearly in terms of discounting the future cash flows, in terms of businesses in particular with really low ROICs and really low ROEs. And so businesses are actually working well below their cost of capital. As their cost of capital go up, management needs to up their game to be well ahead of that cost of capital. And most importantly, kind of the issue that I'm focused on is that boards need to hold management accountable if they're not achieving higher than the cost of capital.
Let's talk a little bit about some of your specific campaigns here in Japan, because, of course, you know that we have seen those quality issues, bookkeeping issues with NIDIC, for example. When it comes to NIDIC specifically, have you seen some of those changes that you want to see? How satisfied are you?
Actually, I'm very satisfied with their new plan. Next challenge is to see them execute on that plan. So they're going to go ahead and revisit 40% of their businesses. That's great. We want them to go ahead and get out of their e-axle business in China. Great. They're going to go ahead and look at a lot of other low return, low ROE businesses. Great. Let's see them. Let's see Kishida-san go ahead and execute on that. And also importantly, let's go ahead and see them resolve the most recent investigation and hopefully get a clean audit.
How confident are you about their underlying business strength?
Oh, I'm very confident of the underlying business strength. They make incredibly important products. It's used in an enormous amount of machinery parts and machinery parts all over the world. They have a very robust business, albeit this culture that existed under Nagamura-san clearly has to change. they have to go ahead and, in my opinion, hold Nagamori-san responsible for it. The independent report did hold him responsible. There's a responsibility committee that's going to continue looking at whether there's legal angles as well against Nagamori-san. We're looking forward to that culture change being replete across the company. So this was actually what we have not typically seen in Japan is actually typical financial fraud. And this is not my words, this is the words of the independent committee, that they just were going ahead and systematically, fraudulently reporting higher numbers, or often higher numbers, like 10 to 20% higher in operating profits than they historically had, than really were, by misbooking expenses as capex, and then systematically writing down that capex in the future, at periods in the future. And so that issue was systematic. This issue was going on for a long period of time. Most likely, the company was paying taxes that didn't necessarily own. Most likely, they would have taken much more proactive action. And when it did finally, they didn't get a clean audit, they took proactive action. And we're really glad that there's a cleanup of that culture. Or we hope that we can see a complete cleanup of that culture, because the products are extraordinarily necessary. It's a great company for Japan, and we hope to see it has much better days.
Seth, when it comes to Japan, we're also seeing, I guess not only Japan, countries around the world, national security becoming a priority. We have seen, of course, the government stop MBK partners from purchasing Makino Millings, for example. Does that give you some pause on the progress and changes that we're seeing in the Japanese business environment when it comes to foreign investments?
No. I mean, in terms of, I should say, and actually I think the far majority of investors are looking for strong Japanese companies to remain Japanese, produce higher returns. We're not talking about, like in Makino Milling and MBK, in terms of companies being barred from buying companies. Invariably, we're looking at companies that have fantastic Japanese IP to go ahead and monetize IP better. We're talking about NIDEC. Let's go ahead and execute and fixing the culture and going ahead and yes, reporting accurate numbers and getting re-index in re-index. We're talking about companies like Kyocera. Let's go ahead and focus on your core businesses and produce more profits. So in these cases, is all consistent with what Prime Minister Takichi has in terms of let's produce a better and stronger Japanese businesses and better and stronger Japanese economy. So, in a lot of other businesses, we're talking about let's go ahead and build data centers onshore to protect national security. I think most investors that are investing in Japan are not looking to take IP out, not going to take businesses away from Japan. They're looking to get higher profits for Japanese companies and have them remain in Japan.
Seth, the lion's share of your interest remains in the Japanese market, though. I think last year we asked you about some of the other markets that might be sort of up and coming. We asked you about South Korea, for example, and the opportunities for activist investment in these markets. Where else are you sort of turning your attention to at this point?
Well, we're spending a lot of time in South Korea. We're extraordinarily happy with the changes that have happened there. Clearly, there's been an extraordinary run in the back of memory. And yes, the knock-on effect from the enormous investments going on globally in AI. So we spend a lot of time in South Korea. We're spending a lot of time in the additional amount of issuances going on in Hong Kong, the additional amounts of capital flows capital flows, as well as need for investment in Chinese companies and greater Chinese companies. And so we continue to invest in China and actually in Hong Kong as well.
Right, Seth Fischer, founder and CIO of Oasis Management. Really good to have your thoughts as always. We talked about NIDEC there with Seth. We will actually get the CEO, Mitsuya Kishida, joining us later in the week, Haidi, to hear how they're progressing with some of the changes at their company as well.
Yeah, and from Japan to the US, we've been following this particular congressional race in Kentucky, right? We do have a result. Donald Trump's handpicked candidate for the congressional seat in northern Kentucky, Ed Gallrein, defeating the president's nemesis and the longtime GOP House member Thomas Massie. This has been one of the most expensive primaries on record. This is according to a projection from Decision Desk HQ, with 58% of the vote counted. Gallrein had about 54% to Massie's 46%. This is perhaps a clearer sign yet that The president's grip over the Make America Great Again base in the solid Republican states remains pretty firm, even as we see national surveys and polling showing that the broader electorate is turning sour on his handling of the economy, the war in Iran, what we're seeing with oil prices domestically, and so on and so forth. So the relative newcomer to politics, the 68-year-old Gallrein, has been successful in the Kentucky Republican House primary. More ahead here on the Asia Trade. This is Bloomberg. Take a look at what we're watching when it comes to the surge that continues in yields. And it was interesting, this conversation now switching to how does this begin to impact really ongoing when it comes to risk assets, including equity markets, companies that are perhaps beginning to be exposed going forward to higher borrowing costs as a result of these yields. US 30-year yields hitting the highest since 2007 with that sell-off just deepening. We've seen that being replicated in Japan as well with that 10-year at about 2.8%, approaching 3%, highest levels in about 30 years. US futures, though, at this point are still a little bit optimistic, about 0.1% they're higher. We're seeing the Bloomberg dollar also holding pretty steady. That dollar strength has given a bit of respite to to Asian currencies, I should say, in this part of the world in particular. When it comes to bond futures, we continue to really watch for really the impact that we see of bond vigilantes returning to this market as well. This sell-off continuing to be extended, with the longest dated bond rising to the highest level in terms of that yield in almost 2 decades. This is all on the back of broader investor concerns about accelerating inflation as a result of this ongoing situation in the Middle East. The Strait of Hormuz, as a reminder, remains closed. We're hearing that perhaps NATO is contemplating a plan to try and guide vessels through it. We've got President Trump now also threatening again further attacks on Iran if there's no acceleration towards a deal on a more permanent truce. Here in Asia, we're looking pretty lackluster. We've got Sydney futures just about 5 minutes away from the start of trading in these markets, looking like we'll start off softer, 0.3%. Nikkei futures also down by 0.5% there. Seoul Kospi futures in the positive, 0.7%, looking to stabilise following the pretty sharp sell-off we saw in the Monday session and the volatility that we saw in overnight session with that dramatic intraday turnaround in ship names. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. Haidi, we're seeing oil prices easing early in the Asia session. What was interesting, though, was the overnight session when we had oil prices easing, but the global debt sell-off continue, really perhaps giving a reflection of the persistent confusion when it comes to the inflationary risks ahead and perhaps even policy credibility.
Yeah, and none more obvious than where you are in Japan, right? We do start to wonder as to when the impact of these higher yields, that 10-year 2.8% approaching 3%, this is the highest we've seen in about 30 years. When does that start kind of passing through when it comes to the higher cost pressures to Japan corporates, Shery?
Yeah, we're talking about the 10-year yield, 20-year yield, 30-year yield here in JGB's highest levels that we haven't seen since the 1990s. The 40-year yield as well at the highest levels since 2007. And you can see right now at the open here in Japan, not a lot of change when it comes to Japanese equity markets. We are still on watch for bond market stress, intervention fears as well. Take a look at the Japanese yen. We're also very close to that critical 160 intervention zone. We heard from Secretary Bessent, also from the G7, saying that the fundamentals of the Japanese economy are strong, but that he doesn't want excess FX volatility. Today, we do have a 20-year bond auction. We are expecting solid demand. I mean, the yields are high right now, but of course, the global backdrop not so strong at the moment. What was interesting, of course, is that despite surging yields, we're seeing the weakness in the Japanese yen and really reflecting those concerns about the fiscal risk, inflationary threat. Now, more than 70% high hike odds for the BOJ from markets in the month of June. Take a look at how Kospi is also setting up early in the Asia session. We are seeing a little bit of upside, a little bit of divergence with the Kosdaq, which is down 0.7%. We continue to follow the AI story here. Of course, we continue to see the focus on Samsung as those labor conversations continue this week as well. The Korean won, though, look at that, past that 15.10 level, weak against the U.S. dollars. We continue to see the widening U.S. rate differential and perhaps very close to that 17-year low, Haidi.
Yeah, continuing to watch really for that impact when it comes to U.S. Treasuries and the global bond sell-off that spans not just the U.S. but from Japan to Australia and also to Europe as well. It's interesting when it comes to Australia. We could see perhaps a little bit more respite here given how close the RBA is seen to be near its neutral rate. But at the moment, we're seeing Aussie bonds really set to track Treasuries lower on these Fed hike bets there. So the situation remains. So even as we see a bit of a pullback when it comes to any sort of volatility when it comes to energy pricing. But take a look at what else we're watching, particularly when it comes to oil. With Brent coming online, we are seeing downside of about 0.4%. Really a pretty steady picture, though, even as we have President Trump now coming back to resume threats to set upon more strikes on Iran, despite, of course, in the previous day saying that he was going to refrain. The president now saying that if Iran didn't agree to US's peace terms, we may have to give them another big hit. But it is getting to the point where I think parts of the market, when it comes to volatility, at least are looking a little bit more sanguine. Gold, for example, kind of holding on to those losses as the impasse keeps those rate hike bets high. Let's bring our markets reporter Anthony Stevens for more context around this. And Anthony, that sort of, I don't know if it's too early to call it a dislocation, but certainly at least a temporary disconnect between where we're seeing oil prices and where we're seeing bond traders continuing to take off is quite interesting.
Yeah, I think the focus has moved away from the day-to-day kind of announcements and how long the Straits of Hormuz are going to be closed, right? The polymarket odds of the Hormuz staying closed until June is pretty much at like the, at 30% of it being open, right? So this is driving a much larger move in expected inflation, and that is what is causing this move in yields. It's important to note the flow dynamics around yields yesterday, right? That we saw pretty much kind of cutaway selling in treasuries, right? People were cutting positions. $15 billion of treasury block trades went up yesterday. Volumes were 3 times the normal volumes. This is very similar to JGBs. JGBs were around 2 times the normal volumes. Treasury options were around 25% normal volumes, and Treasury options volatility has increased 20% in 2 days. So there's a bit of panic here on the yield front, and that's because, as you guys alluded to earlier, there is a lack of policy initiative here. People are in wait-and-see mode, right? And you end up with a new Fed governor who may or may not do anything about the inflation spike. So the bond market wants to move ahead of this dynamic. So probability of a Fed doing anything on the next 2 meetings is 0.
What does that leave the AI trade then, Anthony?
Yeah, so this back and forth happened very sharply last night, actually. You saw momentum trades and tech open 3 to 5% lower and then scream all the way back to flat, right? As the fundamentals do battle with yield expectations. So we have a JP Morgan tech conference tonight in the US. We have Nvidia earnings tonight in the US, and there's a lot of expectation that the fundamentals will remain strong. So there are buyers on every dip in tech while the fundamentals remain strong. But the hurdle rate to those gains keeps ratcheting higher as these risk-free rates go higher, right? So we are setting up for quite a big battle in the next couple of months about whether the earnings growth can overwhelm these higher yields.
Right. Anthony Stevens, Bloomberg market producer, they are joining us from Hong Kong. Let's get more on the markets with Jonathan Garner, Chief Asian DM Equity Strategist at Morgan Stanley. Jonathan, really good to see you in person again.
Nice to see you.
Anthony was just talking to perhaps some of the challenges on the AI narrative and how global debt is really on that massive sell-off. What are the implications for the equity space when you're seeing yields rise so high?
So when you think about equities, obviously there are two components. There's earnings growth, where the revisions are generally strong, but particularly in upstream sectors like AI-related capex. And then there's the discount rate, which is where those yields come in. And yes, nominal yields are backing up, but we tend to be more interested in looking at real yields because equities are a real asset class, and real yields are also rising. So 10-year TIPS yields are about 2.15. It's nothing to be too alarmed about. The recent peak from 2023 was higher, but it will probably push valuations down a little bit from current levels. But the underlying earnings growth, particularly here in Japan, is strong enough that it means that we have upside to our targets. So our TOPIX target, for example, 4,300, we think that's eminently achievable over the next 12 months.
I was going to say, especially here in Japan, when we're talking about real yields, that story that Japan is back, which sort of got started at around the time this Morgan Stanley-MUFG event started about 2-3 years back. Is that still intact with the Iran war going, with the oil shock, given how dependent Japan is on the Middle East?
Yeah, it actually dates back probably to the middle of the last decade when the famous three arrows of Abenomics really began to work together. So monetary, fiscal policy, and I guess sort of structural reform, particularly corporate governance reform for equities. But there's been bumps along the way, notably during COVID, which was an enormous shock for the global economy. But Japan has tended to navigate it quite well, and the basic policy parameters are intact. And I would emphasize that Japan's fiscal position is far stronger than many people understand it to be. There's declining gross and net debt to GDP ratio, and the underlying fiscal position is about a 1 to 2% of GDP budget deficit. It's actually the best in the G7. So I don't think there's particular concern from a Japan perspective about the rise in yields. I would point out that JGB 10-year yields are still 40 basis points below German 10-year yields in the Eurozone. So, Japan is still able to fund itself in its own currency at very low yields.
We've been talking about inflation being above that BOJ 2% target for the last 4 years, and then you have the oil shock and you have the supply chain disruptions. At what point does it become painful for not only households, but for businesses, and it gets reflected on the earnings potential?
Yes, it's certainly the case that if you say look at the consumer sectors and some of the downstream industries, there is pressure on earnings. There are downward earnings revisions. But Japan has many points of strength in semiconductors, IT, capital goods, defense-related spending, also energy-related spending, that in aggregate it has a very positive breadth of revisions. In fact, it's the most positive. It's number one globally. S&P is number two. And the Eurozone, in fact, is the one with downward revisions in aggregate.
When it comes to that tech strength, semiconductor-related strength, of course, we can't forget South Korea.
Yes.
Incredible rally, though. I mean, at one point, we surpassed 8,000. Where do you see that market going?
So we've set across our coverage very wide bear to bull target ranges going forward. So that certainly applies for KOSPI. So 6,000 is the bear, 10,000 is the bull. And we can trade within that range as these global forces buffet the markets. Korea, for example, is a large oil importer, but like Japan, it has a very high degree of sensitivity to some of these upstream capex beneficiaries, and particularly the semiconductor and memory area. And on that side of things, the earnings revisions continue to be very strong, and my coverage colleagues, the coverage is led by my colleague Sean Kim, are very constructive.
Yeah, I mean, I think it was your colleague Sean Kim who talked about South Korea going down a different memory lane. So perhaps you're considering more of a super cycle when it comes to the semiconductor boom that we're seeing in South Korea that can potentially keep the markets supported.
Yes, that's right. So memory, of course, historically is a notoriously cyclical area, and it is a sort of short cycle capital good historically. But what you're now seeing is that the use of memory in inference in AI is so significant, and the capital spending is so large and structural that you're moving towards long-term contracts. So the hyperscalers are starting to sign long-term contracts with the memory firms, which means that they should trade on a higher multiple. So you've got higher trend earnings growth and probably a higher multiple as well. These kinds of things don't come along very often in investment. I covered the miners, for example, during the China construction boom when they moved into a mining super cycle at the early part of this century, 2003-4.
I was trying to remember what was that.
That was 20 years ago. But yeah, super cycles, by their definition, don't come around there very often. But this is one. This is one.
Are we going to see more markets divergence between the haves and have-nots? Northeast Asia versus, say, India's underperformance, Indonesia, the Philippines.
Yes, so we are starting to see the energy shock really pressurizing some macro balance in parts of South Asia. And from an equity perspective, they have a skew that's very towards the consumer, services and downstream industries. So that pattern of skewedness in earnings revisions is tending to act to the detriment of South Asia markets.
Especially without that exposure so much to the tech and semiconductor supercycle?
Yes, I mean, even if you say look at a market like Australia, which clearly is a developed market, you're seeing the same thing. So areas that are of strength include sort of copper, upstream energy, but some of the financials and the consumer in Australia is starting to get into a more difficult situation.
China?
So China is interesting because China is very resilient in terms of the way the dual circulation economy has worked. It's essentially able to continue to function through the energy shock because it just has so many different sources of energy supply and it can change the energy mix. It's actually been helping the rest of Asia, particularly around reducing its gas and oil imports. The issue for the China indices is, again, you have e-commerce and consumer-facing mega caps that are arguably, and I say arguably because the debate rages, going to be somewhat disrupted by AI. They're obviously investing in AI, but they're at threat from the Chinese indigenous low-cost LLMs. And you don't have yet, you may eventually have, but you don't have yet the upstream chip sector well represented in certainly the offshore indices.
Chinex is quite exposed to some of the hardware names,
yes,
right?
That's right. And that's why my colleague Nora Wang absolutely prefers A-shares and industrial, domestic, semi-localization and tech in A-shares to the broad offshore indices.
Is there sort of the same level of upside potential for Chinese equity surrounding tech when we continue to see the decoupling with the US and Western markets?
Yes, but it gets very stock specific. It's not really an index story. And we have to remember that the underlying deflationary forces for the consumer are still there. You know, that the wealth effect from the property unwind is still there. And so we had some quite disappointing retail sales numbers in China quite recently, which show that two-speed China economy is continuing to be with us.
Yeah, no wonder we're seeing China the only outlier when it comes to that divergence from the global bond route because of the deflationary concerns that you talk about. Jonathan Garner, really good to see you in person again here in Tokyo. He's a Chief Asian DM Equity Strategist on Morgan Stanley. And tomorrow we're also heading to the JP Morgan Global China Summit in Shanghai, and we'll be speaking with Chairman and CEO Jamie Dimon about investment opportunities there. That exclusive conversation at 11 a.m. Thursday in Hong Kong, 11 p.m. Wednesday in New York. This is Bloomberg.
They come to the table, they're begging to make a deal, because they're begging to make a deal. I hope we don't have to do the work, but we may have to give them another big hit. We may have to give them another big hit. I'm not sure yet.
President Trump there threatening, to resume strikes on Iran if a deal to end the war isn't reached soon. And these comments raising the prospect of a return to active hostilities in the Persian Gulf in the coming days. Bloomberg editor Michael Heath is following the developments for us. And it sort of depends on which day you ask the president, right? There's been a bit of back and forth. Clearly there's some pressure from Gulf allies for him to refrain.
Yeah, I mean, look at it. There is a bit of a sense of Groundhog Day, Heidi, isn't there? But it's, obviously, yesterday he did say that the day before he did say that Middle East allies had asked him to refrain. Earlier, in a previous incarnation, he'd said Pakistan had asked him to refrain. I think that the problem here is that he's overdone it quite a lot. So really, they are, if they don't get anything coming to them now, they really are going to have to move and resume some sort of military action. The question is what that is actually going to achieve. I mean, they hit Iran very, very hard, the US and Israel. These are obviously some of the most powerful military countries in the world, and they didn't buckle or yield then. So how that differentiates things is different. We also heard from Vice President Vance, who said there's sort of been some progress made in negotiations, but then Wall Street Journal is also reporting that that Iran really hasn't moved from where it's where it's been, which is the US needs to pay compensation for its damage and lift some sanctions, and that Iran will have some say in Hormuz, and that they're not going to be discussing the nuclear issue, which sort of means we've gone nowhere. So I suspect we're going to see some sort of military action unless something very surprising happens.
So in the meantime, Hormuz remains blocked. The US blockade remains in effect. NATO reportedly now thinking about what it could do to potentially escort some of these vessels through.
Yeah, it's a really interesting report. Excuse me. It's not obviously all of NATO, and NATO needs to be united on this, but there is a discussion about them getting in to escort ships through, and a lot of that's based on the economics. They can see that they're going to have really, really serious problems. I mean, the world is sort of going to head into this situation of weakening demand and rising inflation, this sort of stuff, and it's only going to get worse. So NATO's probably, as that economic case builds, NATO does seem like it's going to make a move. The difficulty again there is, though, that the US tried this at one point, which only lasted for 36 hours or so, because there's just so much fire that comes at those ships, and the US is much more aggressive generally than NATO is, and much more ready for a fight than NATO is. So it's difficult to see what they do. NATO said that they'd like to expand it much beyond the actual alliance. It would be a real multinational force kind of thing. But it is interesting that sort of economic case is starting to build pressure and get other groups involved in this beyond the US, who might be perhaps a bit more successful at trying to talk to Iran potentially as well.
An interesting shift from you break it, you fix it, to particularly in light of how we know President Trump feels about NATO and the moves to reduce military capabilities within the group.
Yeah, I mean, we had this fight with Germany, who's Germany's Chancellor said that the US being humiliated by Iran, which probably reasonably accurate assessment, but that really angered President Trump, who said he was withdrawing 5,000 troops from Germany. Then we've heard that they're not going to be deploying troops in Poland. Poland can take care of itself. So the divide between the US and NATO seems to be growing. I just think that this sort of comes down to the economic pressure that's building, particularly in Europe, on this front. So whether they can actually do anything, I think, really remains an open question. It's just every avenue you look down, it seems to be a cul-de-sac, a deadlock. So it's going to be interesting to see how they actually manage to thread this needle.
Our economy editor, Michael Heath, there. We'll be watching some of those defence names in Europe as well when we get into the start of trading. But this is how European futures are looking at the moment. We had 2 days of gains for European stocks, being really supported by positive earnings results. Investors, of course, still looking at the US and Iran situation and the ongoing pressure when it comes to higher bond yields as well. Shery.
And Haidi, let's take a look at some of the other top global headlines that we're following as well. Bloomberg now learning that Indonesia plans to tighten control over commodity exports, including coal and palm oil, to curb tax evasion and support the rupiah. Sources say the government is set to create a new state entity to manage the exports overseen by its sovereign wealth fund, Danantara. The move would boost foreign exchange inflows. The World Health Organization has convened a meeting of its emergency committee as it searches for vaccines to contain a widening Ebola outbreak. More than 500 suspected cases and 131 deaths have been confirmed in eastern Congo, while Uganda has confirmed 2 cases and 1 death. The WHO has deployed staff and emergency funding, including an additional $3.4 million from its contingency fund. More ahead, this is Bloomberg.
Let's take a look at some of the Korean tech names in particular, as we see really retail investors in this market kind of holding the line ahead of these key Nvidia earnings. Still, we're seeing some signs of stabilization at least. It was a very sharp sell-off on Monday. Volatile US session, quite a bit of downside though for the likes of Samsung and SK Hynix at the moment. These legions of retail investors who support the market against the heaven foreign selling, looking ahead to those Nvidia numbers on Wednesday. We are kind of feeling like this is a sector that needs a fresh catalyst at this point. But Samsung, also some idiosyncratic news there amidst the ongoing wage negotiations, have also managed to avoid an injunction bid in this $445 million patent dispute that's taking place in a court in Texas as well. So while we're watching that, we've got Kioxia also down by 1.7%, and SoftBank, one of the biggest names that we're seeing to the downside, over 7% lower. Some of these concerns over the bet on OpenAI raising some concerns, but really getting wrapped up in the broader sell-off as well. Well, we are watching Nvidia, of course, that much anticipated update on the state of the artificial intelligence economy. It's reporting first quarter results, as I mentioned, later on Wednesday. Our Bloomberg tech co-anchor Ed Ludlow takes a look at how the Chinese market continues to cloud the outlook for the world's most valuable company.
There's massive beat and raise expectations for Nvidia. The market really believes the momentum continues. Top line growth 80%, bottom line growth 84%. But China is still the overhang for Jen-Hsun and his company. Post the trip to China with the president, there wasn't really a net conclusion. Jen-Hsun projected confidence when I was able to ask him about it just before earnings. But the reality is it's still up to China.
The Chinese government has to decide how much of their local market do they want to protect, and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
The environment is really clear. Demand is outpacing supply, and that manifests itself still in memory chips. Jen-Hsun talking about the idea that the supply chain is doubling, maybe even quadrupling per annum. But it's over the next decade that we're still going to see that mismatch. And so that is the question that markets will pose. Where is the continued growth momentum coming from in the face of supply constraints? And also, what is really going on with China? Because right now, the base case assumption is that China is zero revenues. It's definitely a market that Jen-Hsun and Nvidia want to be in. Ed Ludlow for Bloomberg News in San Francisco.
We do have some breaking news when it comes to EU-US trade, with the European Union expediting the beginning of the US trade deal and about to President Trump's demand. This, as we knew that it was sort of crunch time for this trade deal. The bloc's negotiators had been gathering in Strasbourg overnight, where the European Parliament is in session this week. The three main EU institutions sent representatives in the evening to discuss into how the bloc is going to finalise such a deal. President Trump, of course, has been putting pressure through these threats to follow through on the risk of more tariffs being imposed as well. We've seen Washington losing patience with the pace of the EU's legislative process. This July marking a year since Trump and the European Commission chief Ursula von der Leyen agreed to the accord back in Scotland at Trump's golf course. That's where it took place there as well. So that failure to reach an agreement, risking meeting that deadline of July 4th that was set by President Trump. We're now hearing that the EU is expediting the start of that US-EU trade deal. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to broader commodities. Of course, oil prices are actually comparatively stable if you take a look at what's going on when it comes to bond yields globally, but that's steadying there. A bit of downside for Brent crude, trading lower by 0.5%. Some gains being held when it comes to European gas futures, though, as concern continues to build about that rally being really driven by the tightness in that market. But oil, of course, continue to see a bit of a reaction when it comes to President Trump's latest threat to resume strikes on Iran. Trump saying that if Tehran doesn't agree to more peace terms, we may have to give them another big hit, were his words. Take a look at gold at the moment. We're seeing a bit of upside, about 0.5%, but of course it's not just the geopolitical risk, but also the higher yields risk of what we could see from the Fed as well there. Geopolitics still firmly in focus, of course, with Russian President Vladimir Putin arriving in Beijing, aiming to reinforce ties with the Chinese leader Xi Jinping and make progress on a long-stalled energy project. Our Chief North Asia correspondent Stephen Engel joins us now from Beijing. There's really been no pause when it comes to these diplomatic visits in Beijing and the ties that President Xi continues to build?
Absolutely. They've rolled out the red carpet all year long. We had, of course, Keir Starmer here. We had Friedrich Merz from Germany. We had the Canadian Prime Minister. We've had the South Korean President. We had Donald Trump last week. Now, of course, we have Vladimir Putin here really to reinforce their strategic partnership, no doubt, as by the way, I might add, not as a side note, as the backdrop, the war in Ukraine obviously going into its 5th year, and the Russian shipments of oil and gas to Europe all but dried up because of the sanctions against Russia. So Russia simply needs China. It is a strong partnership, a strong alliance to be a counterweight to the West, but it's an uneven relationship because, again, Vladimir Putin needs to have those continued Chinese purchases of energy. And on the table is getting the Power of Siberia 2 gas pipeline that runs from central Russia through Mongolia, through to Beijing and on to Shanghai, across the finish line. China's been sort of holding out for better terms, and I think Vladimir Putin would probably tell us he thinks he has some leverage right now because of the war in Iran and the resulting energy price shock could perhaps be that negotiating tool that Vladimir Putin could get Xi Jinping to finally sign off on the contracts for gas and the commitments, the multi-year commitments that Moscow is looking at to justify the cost of building this thing. Okay, now Russia would pay for the pipeline on their side. Mongolia would simply tax the gas coming through their territory. China would then perhaps build on their side of the Mongolian border. But estimates have ranged anywhere between $13.5 billion upwards of $30 billion. It's a lot of money if China is not going to commit to a steady supply. So that is why Vladimir Putin is here, along with kind of trading notes with Xi Jinping on how the summit last week with Donald Trump went.
Yeah, that's going to be interesting, right? Because we've kind of seen the dust settle a little bit from what was optically a very positive and warm meeting. I do wonder, some of the sort of diplomatic requests that the US had, are there any signs that Beijing is actually going to make good on those, given that we know behind the scenes there's probably still quite a level of distrust in terms of what they can expect from the US side?
Baby steps, right? Heidi, we need to do baby steps here. This was just 36 hours of meetings between these two people. It was highly symbolic. I think we got, quite excited because he was bringing along with him a big contingent of high-level executives, everyone from Elon Musk to Jen-Hsun Huang to Tim Cook and David Solomon, and the list goes on. But the list of deliverables on those deals was fairly short. Even on soybeans and beef and some of the agriculture products that China has committed to, there's still uncertainty on whether China will be able to, and if tensions flare again or tariffs flare again, whether they pull back on that. So that's not a sure thing. We didn't even get any kind of deal on the H200 chip, which Jen-Hsun Huang has told Bloomberg News that China wants to buy those. The White House has already signed off on those, but where are those commercial deals? It's going to take some time. And fortunately, Xi Jinping will be going to Washington on September 24th for a reciprocal state visit. We're going to have APEC meetings in the fall as well, as China is host of APEC. We are on our way today down to Suzhou for the trade ministers meeting of APEC. And there's going to be multiple opportunities for these two leaders. I'm talking Trump and Xi to meet throughout the rest of this year. And at the backdrop, of course, is just a reinforcing today of the Xi-Putin relationship. Interesting times.
Mm-hmm.
Stephen Engel there joining us from Beijing, our chief North Asia correspondent. And of course, another relationship that we're following, the leaders of Japan and South Korea promising to boost cooperation on energy and security amid increasing geopolitical uncertainty. It follows a meeting between Prime Minister Sanae Takaichi and President Lee Jae-myung in his hometown of Andong. Bloomberg senior editor Brian Fowler joins us now with more on this. And Brian, the choice of venue was interesting, but also we have seen this familiar closeness between the two leaders in their jam session on the drums earlier this year as well, right? Was there anything concrete, though, that came out from this summit?
Yeah, well, I think, Shery, first, just the broad takeaway shows that the extent to which geopolitical turbulence around the world can bring people together. Before these two people took office, there was a lot of concern about how the relationship would go. Takaichi was a very vocal right-wing lawmaker. Lee had been very critical of Japan for its annexation of the Korean Peninsula a century ago. And now it's all about what they have in common. They share a dependency on Middle East oil, a reliance on the U.S. to help with security. And of course, they both have concerns about the rise of China and North Korea as a potential destabilizing factor in the region. I think the most concrete area where they agreed on would be in the realm of energy. They agreed to share information more closely in terms of stockpiles. And they also agreed on a swapping arrangement whereby one nation would lend crude oil or petroleum products to the other when there's shortage. Now, whether that actually works in this situation, I think in normal times when maybe an earthquake, for example, disrupted the industry in one country and there was a shortage there, it might make sense. I'm not sure how much sense it makes when they're both dealing with the exact same problem, which is supply disruptions owing to stoppages in the Strait of Hormuz. But I guess, going forward, that will be something that could come in very handy.
And Brian, of course, coming off this summit between Presidents Trump and Xi Jinping, where we saw, of course, the growing partnership, perhaps, or at least the easing of tensions between the two sides. Has that led to any shift in tone or sentiment among these two other leaders that, of course, also contend with a more assertive Beijing here in the region?
Yeah, I think one interesting thing was that the two leaders seem to have slightly different emphases going into the meeting. Lee was really all about energy and supply chain resiliency. He wanted to become part of Takaichi's efforts to secure supply chains around Asia. Takaichi was a little bit more heavy on the security aspect. Of course, in both cases, they both share these interests. Also, on the point of North Korea, Lee had said that he wants to see peace on the peninsula without any kind of conflict. He didn't mention anything about nuclear programs, whereas Takaichi was very specific, citing nuclear programs as well as missile tests as a particular point of concern.
Senior editor Brian Fowler there joining us with the latest on that summit between Japan and South Korea. As we keep an eye on the FX space, of course, we have been watching the Japanese yen holding at that 159 level against the U.S. dollar, very close to that potential intervention zone from authorities at that 160 level as well. The Korean won continuing to weaken against the dollar past that 1,500 level, despite, of course, what we've seen in the equity space with those gains year to date on Korean stocks. We continue to see the widening U.S. rate differential, so the Korean won very close to that 17-year low. Same for the Indonesian rupiah, the Indian rupee, the Philippine peso have been some of the biggest losers, underperforming Asian FX since the Iran war began. And Haidi, today we do have the Indonesia rate decision, a hike expected there.
And of course, tariffs and trade never far from the fore, right, Shery? We had the breaking news just a few minutes ago. The EU is expediting the start of its trade deal with the US following increased pressure from President Trump. Our chief Asia correspondent, Rosalind Matheson, joins us now with more. And Ros, was it surprising at all that negotiators managed to reach that decision in Strasbourg, given that we know President Trump had been throwing, renewed threats if that July 4th deadline wasn't met?
Well, it has taken a long time to get to this point. I mean, this deal was initially struck in July, so almost a year to get this far. And obviously, US President Donald Trump was getting frustrated about that. He was threatening that he was going to hike tariffs on the EU unless they got this deal over the line. He set this deadline, he's extended it to July the 4th, but certainly that was front of mind for lawmakers in the EU. But the EU had also said it did want to get this deal across the line. It's just a complicated block with a lot of factors to take in. But what we do know now, of course, is they have finalised the text. That's European lawmakers, EU lawmakers and member states have agreed to finalise this text. And what that does, of course, is it means that no levies on US industrial goods going into the EU. And it means a ceiling of 15% on tariffs on most European goods going into the US, and that's really important in particular for the European car sector, of course, the auto sector, watching nervously the threat to increase tariffs on cars again to about 25%. So it's one step forward. There are two steps to go in this process. The Parliament still has to ratify it, and then individual European states have to ratify it. So we're not quite there yet, but certainly for Donald Trump and for the EU, it's a big step in that direction.
And really, we'll be watching the European Parliament, right? They repeatedly blocked the ratification. Not surprising, given that the U.S. Supreme Court itself undermined some of President Trump's tariffs. So what will you be watching as we await the European Parliament and also those individual states?
Well, that's right. So you've got tensions between the Parliament. You've also got tensions between individual European states and the US, including Germany most recently, because Germany's been quite critical of Donald Trump for the war in Iran, for example. And Germany is a key country when it comes to the auto sector. So you've got all these other factors coming into the relationship. As you were saying, the Parliament said previously, let's hold up on this deal because let's see what happens in the aftermath of that US Supreme Court ruling that struck down Donald Trump's use of emergency powers when it comes to trade. There's also the question always of Greenland. If Donald Trump starts musing aloud again about annexing Greenland or trying to buy Greenland or whatever he says, then sometimes they say, well, let's stop again and see what that happens. So all these other factors keep coming into the relationship. And above all, what that tells us is that even if this deal does get finalised and we see this trade deal implemented, fundamentally underneath that, there's been a real breakdown in trust between the US and the EU in the sense that neither side views the other anymore as a reliable partner.
Our chief Asia correspondent Rosalind Mathieson there with the latest on the EU-US trade deal. More ahead. This is Bloomberg.
Take a look at some of the movers to the downside in this session. We are seeing Samsung perhaps reversing what we're seeing in the rest of the Korean session there. We're up by 1.1% as we continue to see those ongoing wage negotiations. Some of that Korean retail element sort of staying by the sidelines as we await those key Nvidia numbers on Wednesday. That'll be the next fresh catalyst that this AI and chip-driven market has been waiting for. In the meantime, for SoftBank, we're seeing downside, although we're out off those session lows of over 7% at one point, as we see more broadly really rising yields in Japan hitting almost the highest that we've seen in about 30 years, potentially starting to pressure some of these tech plays. The issue of debt funding at play there as well for SoftBank. And in fact, that $60 billion bet on OpenAI is facing some new questions as Masa doubles down on Sam Altman's vision. Bloomberg's learned that rising competition from Anthropic is fueling fresh doubt even within SoftBank itself. These concerns are the focus of today's Big Take, and our Asia technology editor Mayumi Nagishi joins us now for more. So Mayumi, what are we looking at here?
Yeah, so SoftBank's Masayoshi Son is really doubling down on OpenAI, and he's committing to close to $65 billion on OpenAI, and specifically on Sam Altman's ability to lead the way into the next AI future. And it's to such a point that we are hearing that insiders, even insiders who have been loyal to Masayoshi Son for years are getting increasingly uneasy. We've been hearing that raising concerns about possible retreat in ChatGPT or OpenAI's place in the AI race against rivals like Anthropic or Gemini, that such topics are becoming taboo. We've heard that, some people have brought up, more as a formality, the possibility of a credit risk. What happens if we're putting all this money into this one company, and what if the worst case scenario happens? There's so much uncertainty in AI. We don't know what's going to happen 3 months from now. What happens if, though unlikely, OpenAI goes under? And that question, we've heard that Masayoshi Son has shut down And it's more that sort of inability or to listen to sort of things that he might not want to hear that's increasing even more concerns within SoftBank. So
what's really interesting is this is more about Musk's kind of relationship, the conviction that he has in Sam Altman as a person, as a leader, right? And is that why we're sort of starting to see people concerned that we could see, an even more expensive repeat of what we saw with WeWork?
Correct. I mean, the stakes are so much higher now than at WeWork. The amount of money that's being thrown around is just immense, and SoftBank has had to, liquidate, sell off some of its crown jewels in its portfolio. It had to sell off its entire Nvidia stake that it's accumulated. It's, cashing in on some really good AI companies in its portfolio, and it's also increasing its debt. So, this all in, SoftBank going all in is coming at a time that Sam Altman's credibility is under attack, and we know that in his past partnerships with Microsoft, with Apple are fraying, and, his fellow co-founder in OpenAI, Elon Musk, has sued him and is threatening that he might, appeal that suit again. And so the questions are circling not just outside SoftBank, but within. Is this wise? Do we know what we're doing? And it's one of the things that makes executives, insiders, his partners outside, they follow Sohn because of his optimism. They follow him because he has such faith in entrepreneurs who are brave enough to dream big. The question is he not listening to sort of the more cautious voices among his lieutenants?
Bloomberg's Asia Tech editor Mayumi Negishi there. And of course, subscribers can get more on this story for terminal clients. The function is NI Big Take. It's also available on Bloomberg.com. As we continue to follow the AI trade, of course, the fresh catalyst that we're expecting is from Nvidia's first quarter results. Now, this will be the whale of the season, Haidi, because we're expecting their sales to increase by about 80% in this period. Now, yes, they're the world's most valuable company, approaching a $6 trillion valuation. Their acceleration in the sales numbers, the fastest clip in more than a year. But at the same time, we're talking about a company that faces risks ahead, right? First of all, ramping up production. They have to ramp up the output of the Rubin lineup, the new version of AI chips. And of course, they also have to fend off competitors. Yes, they're the biggest company in the world, but there is AMD, Broadcom, Google making their own chips. So this is one key commentary that we're going to be watching for when it comes to Jen-Hsun Huang. And of course, the China market, I'm not even going to get into that.
Yes, well, let's do get into that, right? Because we know we had the optics of Jen-Hsun Huang being included at the last minute on President Trump's visit to meet with President Xi, I should say, in the 36-hour leadership summit last week. He was on the plane, he was on the streets of Beijing, he was, enjoying the local delicacies, and he said he was there to support the president. But obviously, there is that element of just how lucrative and key that China market remains. We didn't get a whole lot in terms of a commercial agreement when it comes to those key chips either, but that will be something to be in focus. But at the moment, that conversation when it comes to AI valuations, chip valuations, it's sort of transforming beyond just whether we can see more scale, more production, but also not just enough shipments, but also whether the broader kind of industry can create enough usable economic compute without overpaying at this point. And that's going to be key, watching these earnings over, the coming days, but also over the coming periods as well and quarters as well. But the other thing that we're watching is also these concerns over the spending of AI data center, in particular when it comes to borrowing. The data center boom is getting pretty high when it comes to Wall Street's potential list of credit threats at this point. It could potentially sow the seeds of the next market shock. That's a concern. Around 34% of global fund managers surveyed by Bank of America saying that AI hyperscaler capital spending, that is the most likely source of a future systemic credit event. That is double the share of respondents from back in April. We've seen tech companies borrowing some $300 billion from US investors to fund the AI spending boom since the start of last year. Billions more to come are predicted in the months ahead. So perhaps no surprise there is starting to see some caution coming in. More ahead on the Asia trade. This is Bloomberg. The top corporate stories that we're tracking, and Live Golf is said to have started laying the groundwork for a potential US bankruptcy filing if it fails to raise new funds. Sources say the league is currently looking for money after its main backer, the Saudi Public Investment Fund, pulled its funding. We're told that they're preparing for its potential collapse when the season ends in late August. Samsung and Google are unveiling new smart glasses with a launch planned later this year. Built with the Warby Parker and Gentle Monster groups, the devices let users interact with Gemini by voice. Features include directions, calls, translations, and camera-based queries. Pricing, timing, and privacy details are yet to come. Well, that is just about it for the Asia trade. Our markets coverage continues. We look ahead to the start of trading in Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.